After talking to some of the people who actually study markets for a living, economists, fund managers, people who lived through the crashes the rest of us only read about in textbooks, I started noticing something that made me genuinely uncomfortable. It wasn't a specific prediction. It was something quieter and, in a strange way, more useful. Almost every single one of them told me the same thing. Nobody rings a bell when it's time to get out. Wall Street will never send you a warning. And I think understanding exactly why that's true matters a lot more than trying to guess the exact week something happens. I want to be honest with you about what this video is and isn't right at the start, because I think that honesty is actually more valuable than any dramatic headline could be. This isn't me telling you to sell your stocks this week, and I'm not going to hand you an exact portfolio and tell you it's the one true way to protect your money. I'm not a financial advisor, and frankly, neither is anyone else you've ever watched make that exact claim on the internet with total confidence. What I am going to do is walk you through the actual reasoning of people who study this seriously, the real signals they watch, the arguments on both sides, and what I've come to believe is actually useful for an ordinary person to do with all of it. If you want a single sentence for what this video is really about, it's this: understanding the pattern behind market risk is valuable. Pretending anyone can tell you the exact week it arrives is not. Let me start with the thing that reframed this whole subject for me, because I think it's the single most important idea in the entire conversation. Every single person I spoke with, without exception, when asked directly whether they could predict the precise timing of the next serious downturn, said no. Not modestly, not as false humility, genuinely, structurally no. And the reason isn't that they haven't studied hard enough. It's that markets are, at their core, a reflection of what millions of people collectively believe right now about the future, and that collective belief can hold steady far longer than the underlying fundamentals would suggest, right up until it doesn't. And the exact moment it breaks is determined by psychology and timing that has defeated professional forecasters for as long as markets have existed. Several people pointed out something that I think is genuinely important to sit with. Markets have famously stayed expensive by traditional measures for years at a stretch. And people who called a crash too early didn't just miss the top, they missed years of further gains waiting for a collapse that arrived much later than they predicted, if it arrived in the specific form they predicted at all. Being early and being wrong look identical for a very long time. So why doesn't Wall Street warn you specifically? I asked this directly, and the answer several people gave wasn't about conspiracy, it was about incentives, which I think is actually more useful to understand. The financial industry broadly makes money from activity, from assets under management, from trading, from continued participation in the market. A sustained message of get out now and wait doesn't fit well with an industry built around continuous investment. That doesn't mean individual analysts are lying to you. Many of them are being completely sincere within their own framework. It means the overall incentive structure of the industry isn't built to produce loud, early warnings, even when individual people inside it are personally worried, because a wrong early call costs a firm client relationships and fees, in a way that being wrong quietly, alongside everyone else, generally doesn't. Now, let me walk you through the actual signals that came up again and again in these conversations, because I think seeing them laid out honestly, with the disagreements included, is far more useful than a single dramatic claim. The first signal is valuation, essentially how expensive stocks are relative to the actual profits the underlying companies are generating. Several analysts pointed to measures that look at stock prices relative to long-term average earnings, and by these measures, broad market valuations have, at various points in recent years, sat well above their long-term historical averages. Here's the honest complication though, and I want to be fair to both sides of this. Elevated valuations have preceded serious downturns in some historical periods, and they've also simply persisted, sometimes for a decade or more, without a crash following at all, especially during periods of unusually low interest rates or genuine technological transformation that legitimately changes what companies are actually capable of earning going forward. Several economists told me that valuation alone has one of the worst track records of any single indicator for predicting short-term timing, even though it has a genuinely useful track record for predicting long-term average returns over periods of 10 years or more. In other words, it might tell you something real about the next decade. It tells you almost nothing reliable about the next few months. The second signal is debt, both government debt and household debt, and this one came up constantly. Several economists pointed to historically elevated levels of government borrowing across major economies, alongside consumer debt that has, in various measures, climbed toward levels last seen before previous downturns. The concern, as it was explained to me, isn't that debt itself automatically causes a crash. It's that high debt levels reduce the system's overall flexibility to absorb a shock, whatever that shock eventually turns out to be, because governments and households under heavy debt loads have fewer good options when something does go wrong, whether that's raising interest rates to fight inflation, or simply consumers pulling back on spending when their own monthly obligations already feel stretched. The third signal, and this is the one that came up specifically in relation to housing, is affordability. Several housing economists made a case that in a number of major markets, the relationship between average home prices and average household income has stretched further than historical norms would suggest is sustainable, and some have argued that a meaningful correction in the range some put at around 30% in certain overheated markets would actually be necessary to restore anything resembling historical affordability. I want to be fair to the other side of this argument too, because it exists and it's serious. Other economists point out that housing markets are intensely local, shaped by supply constraints specific to individual cities and regions, interest rate environments, and immigration and population trends that can support elevated prices for far longer than affordability metrics alone would suggest, and that national predictions about housing corrections have a genuinely poor track record of playing out as forecast, even when the underlying concern about affordability is completely legitimate. The fourth signal, and the one that's newest to this specific conversation, is the current enthusiasm around artificial intelligence. And I want to walk through this one carefully because I think it's one of the more nuanced disagreements happening in markets right now. A significant share of recent stock market gains has been concentrated in a relatively small number of companies closely tied to AI infrastructure and development. Several analysts pointed out that this concentration itself is a risk worth taking seriously, independent of any views on the AI technology itself, simply because when a large share of overall market performance depends on a small number of companies meeting extremely high expectations, any disappointment in that narrow group can have an outsized effect on the broader market, even if the rest of the economy is doing perfectly fine. On the specific question of whether the AI boom will straightforwardly translate into higher profits, the honest answer from the people I spoke with was genuinely divided. Some believe the technology's productivity gains are real and will eventually justify current valuations as those gains show up in company earnings over the coming years. Others pointed to previous, transformative technologies where the eventual real-world benefit was genuine, but the specific companies that benefited financially weren't necessarily the ones that led the initial wave of enthusiasm and investment, meaning a lot of current AI-related investment could turn out to be directionally right about the technology's importance, while still being wrong about which specific companies or timelines actually capture the resulting profits. I want to pause here and say something that I think is more valuable than any single one of these signals on its own. Every single person I spoke with, when I pushed them on it, agreed that all four of these concerns, elevated valuations, high debt levels, stretched housing, affordability, and AI-related market concentration, have existed simultaneously before, at various points, without necessarily resolving into the kind of dramatic, sudden collapse that a headline like Sell Now implies. Sometimes these pressures resolve through a sharp, sudden downturn. Sometimes they resolve through a longer, slower period of below-average returns that gradually corrects the imbalance without a single dramatic crash date anyone could have called in advance. Sometimes, and this is the outcome several economists thought was underweighted in most public discussion, they partially resolve simply through time and continued economic growth catching up to elevated prices without prices themselves needing to fall dramatically at all. The honest, complete picture isn't collapses coming in a specific number of weeks. It's several real structural pressures exist simultaneously, and history shows they can resolve in several different ways on a timeline nobody has ever reliably predicted in advance. I asked directly, what actually happens to people who try to time an exit based on exactly this kind of warning? Because I think this is the part of the conversation almost nobody wants to hear, and it's the part I think is most important. Several economists describe the same consistent pattern across decades of market history. Investors who sell out of the market in response to fear of an impending crash overwhelmingly tend to underperform. Investors who simply remain invested through the volatility for a specific, well-documented reason. Markets tend to recover a significant share of their eventual gains in a small number of extremely sharp, often unpredictable days, frequently occurring close to the worst of the downturn itself, when fear is at its peak and it feels most instinctively wrong to be invested at all. An investor who sells out to avoid the pain of a downturn and who understandably waits for things to feel safe again before buying back in very often misses exactly those sharpest recovery days, converting a temporary paper loss into a permanent, realized one. This isn't a minor technical detail. Several studies were cited to me showing that missing even a small handful of the market's best days over a period of decades can meaningfully reduce an investor's total long-term returns compared to simply staying invested throughout, even including the worst crashes along the way. I want to be completely honest that this doesn't mean risk isn't real, or that ignoring it entirely is the smart move either. What it means, and what several people were emphatic about, is that the actual evidence-based response to genuine market risk isn't a dramatic, all-at-once exit timed to a specific predicted date. It's a set of ongoing, unglamorous practices that professional long-term investors actually rely on, which I want to walk through now, because I think this is the genuinely useful part of everything I learned. First, diversification. Spread meaningfully across different types of assets, different regions, and different sectors, rather than concentrated heavily in whatever has performed best most recently. Several people pointed out that the specific sectors driving the most concern right now, concentrated AI-related mega-cap stocks, are exactly the kind of concentration that diversification is designed to protect against, regardless of whether or not a crash actually happens. Second, maintain a genuine emergency fund outside the market entirely, sized to cover several months of essential expenses. This isn't an investment strategy. It's the thing that prevents you from being forced to sell investments at exactly the worst possible moment during a downturn, simply because you need cash for an unrelated life emergency. Several economists described inadequate emergency savings as a far more common cause of people locking in real losses than any specific market crash itself. Third, if you're regularly investing over time, continuing that regular investment through volatility, rather than pausing or panic selling, has historically outperformed trying to time entries and exits around predicted crashes for the specific reason described above about missing the market's best recovery days. Fourth, review your specific concentration in any single sector or theme, particularly if a significant share of your portfolio has become concentrated in AI-related companies simply because they've performed well recently, and consider deliberately rebalancing back towards your original target allocation rather than letting recent winners quietly become an oversized share of your overall risk. Fifth, and this is the one I think matters most, be honestly skeptical of anyone, in any format, including videos exactly like this one, who tells you with total confidence that a specific, dramatic outcome is happening within a specific number of weeks, especially if that same message comes packaged with a specific product, portfolio, or service they're selling you at the same time. Genuine, honest uncertainty about timing is the correct, evidence-based position of virtually every serious economist and market historian I've spoken with. Anyone claiming otherwise, with certainty, in either direction, is telling you more about their own incentives than about the actual state of the evidence. I want to end with something a market historian said to me that I think captures the honest version of everything I've described tonight better than any single prediction could. He said, markets have faced serious, legitimate structural concerns, debt, valuation, concentration, technological disruption, in nearly every decade for as long as modern markets have existed. And in every single one of those decades, there were confident voices predicting an imminent, specific collapse. Some of those voices were eventually right about a downturn happening, though rarely on the timeline or for the exact reasons they originally predicted. Most were simply wrong, for years, while the market continued upward regardless. He said the actual skill worth building isn't predicting the exact week things turn. It's building a financial life resilient enough, diversified enough, and unpanicked enough to weather whichever version of the future actually arrives, on a timeline nobody, including the most confident voice you'll ever hear on the internet, can genuinely promise you in advance.